Welcome back to the Weekly Trend Podcast. Today is Friday, September 27th, 2024.
Welcome to the
S&P
Weekly Trend,
500 currently
a
sitting
podcast
at
for navigating the markets through the
57.51.
lens of
I'm
technical
David Zarling.
analysis.
I'm here with Hurricane Water
The Weekly Trend
salesman
podcast is
Ian
provided for
McMillan.
educational
Are you
purposes
hanging
only and
in
does not
there in
constitute any
Charlotte with the
professional
recent weather?
advice. Listeners
we
should
are
not act
obviously
upon the
not
information
as
or
bad
content
as I'm
without
sure
first seeking
our
advice
friends
from a
or
registered
listeners
financial planner.
in Florida or Georgia. South Carolina got it pretty bad.
Well, I'm glad you guys are okay, and I'm hoping the people in the areas you just mentioned are doing okay as well. So last week, we talked about not seeing higher highs in a bear market. Still the same situation this week.
Yeah, more all-time highs for S&P and Dow. Russell just still hanging out. I mean, pretty flat for the week, I guess, the last couple days, but
Well, I did have someone reach out to me that listens to the podcast and is a fellow asset manager. He did appreciate that since his son or daughter has been born, IWM hasn't been at new highs.
yeah,
That's
true.
that's how long it's been. But holding up well. I mean, it's above 210 when you look at IWM, and that's an important level. And if we could continue to hold that and chew through supply, which we now know existed from February of 21 through January of 22, that price formation was all distribution. At the same time, the other thesis is the range that took place from that January of 22 through, let's call it early 24, was accumulation. And so now we wait. We have to see, we have a rising 200-day on small caps. We still
It is
haven't made
rising.
it. And time will tell. I mean, these other areas broke through there much sooner, like S&P 500, the Dow Jones. We now have EQAL, which is the Russell 1000 equally weighted. So the top 1,000 stocks continuing to hold its breakouts, but yet the narratives continue. I know that you like to talk about bricks in the wall of worry.
Certainly a lot. I mean, always plenty in an election year. And really, I think what's kind of surprising, there have been a lot of bricks in the wall. And, a lot of this supposed to be lining up with election year seasonality. I know September is usually a pretty weak month in general. I think I saw, more specifically the second half of September. And we have bucked that trend.
And I think that's an appropriate way to look at seasonality, is it's a tendency, and it's not about when stock prices match the seasonality. It's about when they don't. And if the second half of September is supposed to be weak, now we still have one trading day after today, but we haven't seen that second half of September weakness. And that's something worth paying attention to. That's information to look at and say, hey, that's a little bit out of the norm or out of the tendency. So is this market stronger than we think? Despite election narratives, revisions to government data on the economy, the assumption of some type of landing, yield curve,
Interest rates.
Yeah,
I mean, I guess that falls there. Yeah.
And I know one that you highlighted is just, remember the yen carry trade scare.
Yeah, that's from early August. We had the rate cut, and then rates just started going up again. Can you believe that?
Well, the latest I heard, Ian, is that Chinese stocks going up is bad.
They had a really good week.
Yeah, that seems a little bit odd to say if Chinese stocks are going up, that's bad, when we've had one of the best periods since late October of 23 through now that we've seen in the market, and Chinese stocks were going down.
Yeah, China at its highest level since really 18 months, probably.
And it reeks this week's move. Now, it's still in a downtrend, but this week's move out of Chinese stocks reeks of short closing. Like
I can see that. That's a good thesis.
And all short sellers are future buyers. And so if they're closing out those shorts, when you think about demand and supply, economic law, more demand and supply, price goes up, more supply, demand goes down. The end of a bull market typically happens when you run out of buyers. And the bear market in Chinese equities, regardless of your opinion on China, if you run out of sellers, the same applies.
Yeah,
And
they are. Chinese stocks really struggled. They had a good start to the year like everything else. Good Q1. Really, really struggled, the entire summer, May, August. Big move here. And that just gets you back. Well, I said earlier to the highest level in 18 months. It's still the same spot since 2006. I'm looking at FXI.
okay.
So, that's priced in dollars. If you wanted to look at something not priced in dollars, I guess you could use the SSE composite. Also, same spot since 06, early 07. So same spot since 2015. Definitely a lost decade for your average Chinese stock.
And definitely not risk off if A, we're seeing Chinese stocks stop going down, and B, if they start to build a range or move higher, that's risk on behavior.
Stock
Like,
going down is the first step in here. It's anonymous meeting.
same thing with Buyers Anonymous. When prices stop going up, that's the first sign that the bull could be over. And these things take time, but higher highs and higher lows continue to confirm a bull market. We continue to have the backdrop of rising 200-day moving averages, the backdrop of a breadth thrust in October, early November of last year. I'll call them echo thrusts or breadth thrusts in July of this year. And we don't have what I would call an extension of breadth, meaning when you look at like bullish percent on the New York Stock Exchange or bullish percent of the S&P, you don't sit there and say, oh, we're at extreme, we're at 80 or 90 on the bullish percent. And therefore that's where you start to run into risks of stocks falling off one by one because they've been in unison for so long. Their correlations have been so strong to the upside. We're not there yet. And so there's room here heading into October, which is notoriously volatile. I like to call it a volatility amplifier, and volatility can go two directions, but we don't get to be surprised if we continue to build another range through October, stair stepping higher, or some type of another corrective move, because we get 5% corrections frequently in markets. We get 7% corrections frequently in markets, and we get 10% corrections that are frequent in markets. But we continue to see higher highs, higher lows, rising 200-day moving average. Let's not overcomplicate things.
It is, and it's so easy to overcomplicate things. It's so easy to make brash decisions, right? Screw it. If Kamala's going to win and I think she's just going to be awful, I'll just get a cash now. People get really ahead of themselves. We saw it in 2016, saw it in 2020. We've seen it for hundreds of years. I'm sure people got ahead of themselves back in the 60s. Maybe not. Maybe no one cared about elections. If there's anyone who trades stocks in the 60s, let us know what your walls of worry were like.
Well, Ian, how many elections were not the most important ever?
This one for sure is. It's like ever.
Right.
The
while
future of our
2020
country depends on it.
Right. While 2020 was the most important ever. Before that, though, 2016 was the most important. But before that, 2012.
But before that, remember how important 2008 and 2012 were?
Yeah.
It's the most important ever.
Right. The 96 election, really important.
Remember.
Yeah, until now.
The future of your country depends on this.
The future of the market. So we digress, and sarcastically so, but it's because we humans do a tremendous job of making everything the most important ever. And while elections are important, we do a really good job of trying to make what's upcoming the most important. I'm not saying elections aren't important. They absolutely are. We live in a...
Trust me, 2028, they're going to tell you that it's the most important election ever.
Correct. So while we have that bias in us, the beauty of using technical analysis and charts, the visualization of supply and demand, is we can see the ramifications of an election. If we're breaking below a 200-day moving average, if we are making lower highs and lower lows, well, yeah, let's take that information in as true Bayesians, take that information and value it as being, maybe we're starting to see the supply have control over demand. Maybe we've run out of buyers. Maybe there's just selling pressure at this point in time. But to sit in cash at this point, what's your process then for getting back involved? And if you don't have one and it's just on a hunch or what you think, how many times do our thoughts lead us astray? And so you better have an objective process to identify when you're wrong. And technical analysis does that.
I think this really hit home, and I kind of got a chuckle this week. So my story is it will play into what you were talking about, Dave.
We got time for this. Let's do it.
So we have to do these quarterly memos for the ETF.
Yep.
Just a compliance thing. And we have to fill out slides. Most of it's data driven, and Kevin plops it in there. And really at this point, it's just updating things. But we were joking because one of these slides is a market and economic outlook. We don't provide an economic outlook, and we tell them that it's not part of our process internally, nor does it play a role in what the ETF does. So who cares? But the market, so this will be the second time. We also copied and pasted this in May. So we're now February. There's a memo in late February, a memo in late May, and now here late August. And we've copied and pasted because nothing changed. We remain bullish on U.S. equities, especially with the breakout to new all-time highs in January for the S&P 500, NASDAQ 100, and Dow Jones Industrial Average. As technicians and trend followers, we believe higher highs beget more higher highs until they don't. Now, this is at that time. We have recently experienced one of the strongest 4-month historical rallies in broad equities, with indices bottoming in late October. In each of the previous cases, the type of move did not occur prior to a major market top. In fact, quite the opposite is true. This sentiment still remains, and our opinions have not changed as long as the S&P 500 remains above 4,800 and a 200-day moving average. We will remain bullish on the equity market. So if you thought that those were just things that Dave and I got on here and talked about, But I wonder how frustrated we actually haven't written a new market outlook in 9 months.
Yeah.
Because I can literally just be like, here's what I told you in February. Know what else you want from us?
Right. Ian, have you ever played Uno?
Yeah, with my grandmother. My grandmother loved playing.
So you're sitting playing Uno with grandma and all your favorite family and friends, and the card you draw or gets handed to you says, fight the trend or draw 25. What are you doing?
Cool. Probably drawing 25.
Yeah, I'm drawing 25. I'll have to use both hands.
This is how, and I get it. I get it because I used to do it. I used to pay attention to the headlines. I get it. And I get why emotionally people do it. At some point, building, creating, maintaining wealth it's got to be bigger than the TV.
Right.
Having a process has got to be bigger than the nightly news.
Well, we're not U.S. senators or House of Representatives, so we don't have inside info. Because do you think by watching a certain financial news network or clicking on a certain link gives you an edge? Because by the time it's to that point, it's no longer an edge. And how many times?
I think it's the same with these people that watch ESPN all day. I think it's going to make them better at betting on DraftKings.
Yeah. By the time that information is there, it's too late. B, it's what the crowd is reading. C, do you know how many times those outlets are used for unloading a position?
Yeah.
And so consumer beware.
Or you talk about, right, a lot of headlines out about how invested in David Tepper is in China. Well, we'll see. Maybe he
could
wants
also,
to get out. I don't know.
well, I was just going to say, he needs volume in that market if he's going to participate in it.
He needs to take down those profits and
Maybe help the
buy
Panthers
himself
a little bit.
couple of linemen.
Yeah, he probably needs a little more protection for his QBs. I'm not sure. But the point remains that financial news outlets have an interest and it's not yours. Meaning their job is to get clicks and eyeballs in order to sell razor blades and cars and other things. Because if they don't have viewers, they don't have a product.
Well, my big thing, 90% have never done, like they just went straight from journalism school to, being a gopher at MSNBC or CNBC or wherever, and then work their way up. And like, they've never done, it's the same with ESPN. Like, okay, Skip Bayless played middle school basketball. And like, now you're going to, like, you care about his opinion on like the NBA, like who's the best, who's the worst. It's the same thing.
So don't get,
like, who cares? These people have never made any type of investment decision outside of what target date fund they've got in their 401k.
correct. And they're going to sensationalize headlines for the now rather than understanding that the market is a future discounting mechanism looking out 6 to 18 months in the future. It's a weighing machine. In the day-to-day price movements, those are the trees. The higher highs, higher lows, the rising 200-day moving average, that's the forest. So stop staring at the tree and look at the forest.
These are spooky, though.
Yeah, they can be. I remember when we were in Muir Woods out in California. I think it's Muir. I think that's what it's called. Pretty eerie. I mean, very quiet, but the trees are beautiful. But you got to take it as a collective. You got to take the information as a whole. And so what are we seeing, across the board? We're guilty of being S&P 500 focused, understandably so. One of the best indexes on the planet. It uses momentum.
Yeah, find a new index for me to focus on, and
right,
we'll chat about it.
And maybe in Connor's day, your son's day, there will be a different index. Maybe it'll be in 2 years. I have no idea. And then we'll focus on that index. But for now, the S&P 500 being one of the most prolific indexes for the past, I'm going to say 14 years. It's everything's about relative strength. So where are we seeing strength in this market?
I would say a lot of things it's better than we were a month or two ago. Obviously, tech as a sector, XLK, pretty weak.
Yeah,
Tech is the worst sector today. It's been below a relative 200-day since mid-July. Now, it hasn't fallen apart, and yet markets have gone higher over that time. I'm not saying it's been the easiest ride, but we've gone higher without tech leading. And so that would make sense that things under the surface, more things would be participating. Market goes higher, large cap tech, not really your leader. So, something has to be pushing the market high. Gold miners are better. Gold itself, gold miners look good.
Right. Is that risk off? And when we look at, you brought up tech, and if we look at the forest and say, let's look at tech stocks versus S&P stocks, and you notice that we run into resistance that has a 24-year memory going back to the 2000 time, and tech has paused here. You're just simply saying that doesn't mean the bull market in equities is over. It's just the opportunity to outperform the S&P in using tech is tough at this spot.
But you've had, semis have had a nice relative recovery.
Right.
We're back above a relative 200-day home builders, aerospace defense.
Yeah, aerospace and defense,
which has been pretty good.
Yeah, and there's an aerospace part of that's interesting. like we say aerospace and defense, but when you look at the aerospace space, not too shabby. Are we investing in rockets and spaceships? Are we investing in financials and Chinese equities if the world is about to fall apart?
Probably not.
Probably not.
And Brad hasn't, for me, advanced decline lines are fine. I mean, we're not ripping. This is not November 2023. However long that lasts. It was a long, like, end of March. That was cool. That was fun. Although, I mean, we've had like 3 red days this month. Well, I take that back. Since 3 red days in the last, 3 weeks?
Well, we've had 1 negative week in September. And that was the first week in a notoriously weak month, seasonality speaking. And if we're bucking that tendency, that's risk on. If we look across the risk on, risk off spectrum, and we're buying emerging market tech and emerging market high yield, like emerging market high yield moving higher, or junk bonds moving higher, or you're more out on the spectrum using something like ICVT, which is your credit market for more risk on behavior type tech stocks, those are moving higher. You've got European financials and financials across the board moving higher. I know you shared a great chart on Caterpillar, industrials moving higher. How you just mentioned housing moving higher. Russell 1000 equally weighted, breaking out to new highs. Now you're sitting on the precipice of transportation stocks, which have been sideways since 2021. So 3 years of sideways, 0% return in transportation stocks. And if those are going to confirm and move higher, triple C credit spreads cooling off, I don't know how many more boxes you need to check.
That's quite a few.
Yeah, I mean, what's there to complain about? But people love to complain. And we can be back next week. We can be back below, when you look at the S&P 500, if we're back below 56, 60, okay. So we continue to build that auction process up. And when you look at the auction process from early November last year through now, all these, I'll call them mini corrections, all they've done is caused interactions between buyers and sellers that have moved the process up, have moved the auction pricing up. And that's a quality characteristic. I'd be a lot more concerned if the point of control in this market was much lower, but the point of control in something like the S&P 500 is currently sitting around 5,200. I really don't know what else to tell people.
So does that make you feel like we're more like kind of locked in to stay above 4,800?
Yeah. I mean, I do think there's some levels now that are higher than 4,800 that you can manage risk with, as the way I guess I would put it. You could think
of the 52, 5250.
Yeah, you've got a 200-day moving average at 52.28 on S&P cash. You have the low in April at 49.70. You have the test of a low volume profile near 50. Did you say it? 52.50. So you have some levels here where if selling takes it below those levels, you could say, okay, now the bullish thesis is under threat, and you can always take your foot off the gas pedal at those points. But until that, this market is guilty of an uptrend until that point. I mean, a rising 200-day moving average, rising 50-day moving average.
You mentioned 5,600, right?
Right.
I think below that short term would be a little.
And I could see that. I could see that in October. I could see us coming back to the 50-day moving average, which is around 54.60, 54.70, and making sure we know where the buyers are, because that's all this process is confirming where the buyers are and where the sellers are. It's called price discovery. Price moves lower until it finds buyers, until it finds demand, and then it moves higher until it finds sellers, and then it moves lower. That's in the end what price is doing, because there's trillions of dollars at work across credit markets, stock markets. We haven't even touched on commodities. Well, you did a little bit. You talked about gold itself. Now you're starting.
What about commodities?
Yeah. I think it's interesting. We talked a little bit about oil last week, and we continue to test the 65 to 67 level. Be nice to see that hold from that perspective. When you look at energy stocks, they have broken down. They're in a downtrend. You have a falling 200-day relative moving average versus the S&P. We're below an important horizontal level. So right now, energy stocks are not the place to be. They are an opportunity cost, and that might become more abundantly clear if oil is below that $65 level. But base metals, we saw a strong move out of copper miners, an extremely cyclical and industrial metals themselves, some strength. And here we are sitting with the dollar still fighting this 100 level using something like DXY, a trade weighted dollar. Now, if you see that 100 level on the dollar break, now you're talking about trying to go visit 90 or 89 on the trade weighted dollar. And then you start wondering, well, what does that mean for anything priced in dollars? Again, this goes back to what we talked about last week. Why are we involved in markets? If the dollar, your purchasing power is moving lower, you want to be involved in things that are protecting against that situation. And equities is a place. Some commodities could be a place. That's TBD, to be determined. But all these risk on areas tell us it's still a bull market. Even bonds, I mentioned junk bonds. You have AGG, the aggregate bond complex, a retest of the 101 level. We'll see where that leads. But it is interesting. I think you highlighted this last week. You saw TLT rally prior to the rate cut announcement. And since the rate cut announcement, TLT has moved lower. It's almost as if treasuries are also a future discounting mechanism.
It's almost like it was a well-known, they're back below that 100 level. I don't know, and it goes too, I know what my multi-decade outlook is on bonds. So it doesn't surprise me that it's having a hard time getting into any type of uptrend. And we've talked about there will be counter trend moves, there will be uptrends. But I think just a tough spot. And then, of course, bonds versus stocks, you can't. That is a clean. If you want to pull up TLT versus SPX and slap a 200-day on there, that's been pretty clean for about 3 years.
Yeah. And that's where you're paying the price in a 60-40 portfolio, an opportunity cost price. And it's important to look at ratios. You look at something risk on versus risk off. You look at staples versus S&P.
Yeah.
You look at staples versus discretionary. So while on an absolute basis, XLP, staples, clearing prior highs from 2022, moving higher, but underperforming discretionary. I don't know. Are you buying a Tesla rather than buying bleach? Well, that's information. Because I know from our internal work here, people still like to buy their shoes. People are still going out to eat. And now you're starting to see a change in price for airline stocks.
And what was RTH was going? Yeah, RTH. I think it's a pretty solid absolute chart on a relative basis. That's retail.
So there's really not much else that we can add from a weight of evidence standpoint to highlight how strong this market is.
I think Lowe's hit all-time highs this week.
Yeah. Home Depot.
Been very strong.
So risk on, evidence across the board. Does that eliminate volatility? Of course not. We're heading into one of the more volatile months there is in October. Will there be corrective moves during this? Absolutely. But it's the same, back in March, we talked about buy the freaking dip, BTFD. That's the environment we're in. And I'll get a lot more nervous when BTFD becomes the mantra across the industry, which is not what we're seeing right now from a sentiment perspective.
I would say we are very, very far from any type of sentiment extreme. I mean, even if you look at something like, let me pull it up. I got it in front of me. Put call ratio.
Okay.
I mean, it's still, so we haven't had any extreme moves all year, really.
Except for maybe the August VIX spike. Maybe there was a spike there, or in July. But the information continues to stack up, and I feel like it's appropriate to highlight the supporter of this podcast, the Adaptive Select ETF listed on the NYSE under ticker ADPV, which helps investors access two of the most prevalent factors in markets, momentum and relative strength. Using proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. Investing involves risk, including possible loss of principal. ADPV is distributed by Quasar Distributors, LLC. Ian, we are up against the end of our time, but it's our show. We could do whatever we want. Any other place you'd like to highlight for our listeners before we sign off?
Yeah, I mean, it's not a rip roaring uptrend, a lot of back and forth. I mean, even intraday, but I don't think that takes away. I think that's hard to expect at this stage off the bottom for sure. But we continue to hold up. There's been multiple times where bears could have really done something, but just unable to really get any meaningful supply going in the market. And, I think short intermediate term, 5,600 is a good line in the sand.
Sure. We didn't touch base much on crypto, but you look at Bitcoin above 66,000. I think that's an important level. We've been trying to chew through supply that sits at 70,000. We'll use a nice round number. And that's been going on since the beginning of the year, but we're above a 200-day moving average now. Now, granted, it's a sideways moving average. And so that means a hot mess. So not necessarily by very definition, that's a sideways move. That's not a trend, but the fact that that's holding up could be information about what the dollar does here. But we can't be surprised when I talk about October being about month of volatility and amplifying volatility. Let's not forget that volatility can happen to the upside, and markets do surprising things all the time. The most likely scenario from a seasonal perspective, the tendency would be for some type of sideways range or corrective move in stocks going into the election. But do we really get to be surprised if the dollar's breaking below 100 on a trade weighted basis and we're seeing stocks move much higher during October? I don't think we do.
And then you've got this. Now you got China coming in, which is a risk on. I mean, you just mentioned Bitcoin. I think you got to put that on the risk on bucket. So, I don't see. Okay, let me ask you this. There's what cracks do you see? So not just anything right now that makes you say, this is not as strong as an uptrend.
Yeah, I like this. So I love this because this makes my heart go pitter patter, because we should always be like a good defensive end, head on a swivel when we get through the offensive line super easy. So think some potential red flags. You mentioned tech no longer being an opportunity versus S&P. When you look at the big boys, so the S&P is at new highs, but you look at Microsoft, not at a new high. You look at Apple, not at a new high. You look at Meta, trying to, it actually did this week, create a new high. You look at Google, not at a new high. You look at Amazon, not at a new high. So the very large pieces of the S&P 500. You could even use XLG, which is the largest 50 stocks of the S&P 500, or OEF, which is the largest 100 stocks of the S&P 500. Those are not at new highs. And so that's called divergent behavior. And if those type of stocks don't want to lead, that's one thesis that could say, okay, is this distribution? The other way to look at it, I will put a caveat in here, is that sitting in the hip pocket. So all game long, Pat Mahomes has not played well. You're still winning. I like that scenario, because all it takes is Pat Mahomes starting to play well, and now things are dominant. And so we'll see. I mean, that would, for me, those would be some of the potential red flags. Maybe another one would be how cool the VIX is, meaning it's cooled off since its spikes in July and August.
Yeah.
Does it rear its head again going into October, that we get an increase in volatility and some downside? Could be. How about you? What would you say are, I would, if I can, I would add another one, and that would be if transportation stocks can't clear $70. I think that's a little bit.
T.
Yeah, I'm using IYT. But when you look at that formation going back to 2021, it's very constructive. But if it can't do it, it goes back to the adage: if something should do something and it doesn't, that's where you pay attention. So if IYT can't clear 70 when it looks like it should, that would be information. And if we're back below a 200-day moving average, if we're back below the flush that happened in August, which is at 61.80, if we're back below that and that's a failure, probably hard times for the market. Probably. What about you?
So really, I want to see Russell get above 225, and I don't.
We can have a party if Russell clears 244, 243. I feel like we should have a party for him. Like, congratulations on moving out of the house.
I remember last time we had a party, back in 2021, he trashed it.
Yeah, he did. Table was set.
The whole thing.
Really nice setup on the table, chips and dip and appetizers and chicken wings and a good quality beer. And he came in and flipped the table. No, I think that's a good point. Anything else?
I think S&P and Dow are the only bounce back at all-time highs. Both have RSI divergences.
Okay, so momentum divergences, that's fair.
I like the worst, divergences can diverge in a long time. Dow actually, I think it's fascinating that Dow's looks the best, but its relative chart is so bad.
Well, then what does that say about the S&P then? Being on an absolute basis, the Dow looks fantastic. On a relative basis, it's an opportunity cost, which then we can say, oh, that means there's more strength here in the S&P 500 than we thought, regardless of how it looks.
Yeah, I would agree with that.
Okay. Anything else you want to highlight for our listeners before we wrap it up? Okay. And you're listening to this and you really appreciate the information. One of the ways that you could pay us back is sharing it with others, giving us a high ranking on whatever your favorite podcast platform of choice is. We're across all of them. We hope you guys enjoyed this episode, and thanks, Ian, for being on here again with me this week. And I hope you guys stay dry.
Thank you. Hey, have a great weekend, everyone.